Two coworkers, same age, same salary, same two kids, both sitting down with an insurance agent in the same week. Nina walks out with a term policy costing $30 a month. Victor walks out with a whole life policy costing $450 a month. Same coverage, same $500,000 of protection for their families, 15 times the price. And Victor is convinced he made the smarter, more grown-up choice because his policy builds value and hers expires. 20 years later, the gap between these two families is not small. It's staggering. So let's run the real math and let's talk about why one of them was sold something instead of buying it. Let's keep this honest, because insurance is one of the few products where the person explaining it to you gets paid more if you choose the expensive one. That's not a conspiracy. That's just the compensation structure, and you deserve to know it exists. So we're giving Nina and Victor the same everything. Same age, same health, same family, same need. The only variable is which product they signed. No fear selling, no jargon, just what each dollar actually buys. Start with what insurance is even for, because this is where almost everyone gets turned around. Life insurance has exactly one job. If you die while people depend on your income, it replaces that income so their lives don't collapse. That's it. That's the entire product. So the real question is never which policy feels more sophisticated, it's how much protection does my family need, and what's the cheapest reliable way to buy it. Once you frame it that way, a lot of expensive fog burns off fast. Now look at what Nina bought. Term life is pure insurance and nothing else. She picked a number, $500,000, and a length, 20 years, which covers the exact window her kids are home and her mortgage is being paid. If she dies inside that window, her family gets the money. If she doesn't, the policy ends and she gets nothing back. And that last part is what gets weaponized against term insurance. You get nothing back, they'll tell you, like it's a scandal. But you don't get anything back from your car insurance either when you don't crash. That's not a flaw. That's what buying protection is. She paid $30 a month to make sure a catastrophe couldn't destroy her family. And the whole point of the plan is to not need it. And the term is cheap for a boring statistical reason. Most healthy 35-year-olds don't die before 55. The insurance company knows it, prices it accordingly, and passes that cheapness on to you. You're buying protection against something unlikely but devastating, which is exactly what insurance is supposed to be for. Now, Victor's policy. Whole life is two products bolted together and sold as one. Part of that $450 buys actual insurance. The rest goes into a savings component called cash value, which grows slowly over time. And it lasts your entire life instead of expiring. And on the surface, that genuinely sounds better. Permanent coverage plus a growing pot of money. Why wouldn't you want both? Here's why. Because bundling them lets an enormous amount of cost hide in the middle where you can't see it. So let's pull it apart, because this is the part almost nobody shows you. Look at Victor's first few years. A large share of everything he pays in year one doesn't go to insurance or to his cash value. It goes to commissions and fees, which is exactly why that policy was recommended so warmly. Check the cash value on most whole life policies after 2 or 3 years, and you'll often find it sitting at or near zero. Thousands of dollars in, almost nothing to show. And if Victor tries to cancel in those early years, he can get hit with surrender charges on the way out. So the product is engineered to punish you for leaving early, right when you're most likely to realize you don't want it. And a lot of people do leave. A meaningful share of whole life policies get surrendered or lapse long before they ever pay off, often within the first decade, because that premium is genuinely hard to sustain for 30 years. And when someone walks away early, they typically walk away with far less than they put in. That's the quiet failure mode nobody puts in the illustration. And here's the detail that stuns people, because it sounds like it can't possibly be true. With most traditional whole life policies, when Victor dies, his family gets the death benefit. That's it. That cash value he spent decades building, the insurance company generally keeps it. You don't get both. Read that again. The savings account you were sold as the great advantage typically vanishes into the company at the exact moment your family needs it. There are ways to access it while you're alive, you can borrow against it, but borrowing against your own money at interest is a strange thing to call a benefit. So run the 20 years. Nina pays $30 a month for protection, and she does one more thing. She invests the $420 difference every single month in a boring index fund. 20 years later, her family had full protection the entire time. And that invested difference, at a reasonable long-term average, has grown into somewhere north of $300,000. Money she owns outright that she can reach anytime. Victor's cash value over that same stretch. Realistic whole life returns after fees have historically been modest, often in the low single digits. He might have a fraction of what Nina built, locked behind rules that his family generally won't receive on top of the death benefit anyway. On raw math, it's not a close fight. Term plus investing wins decisively. There's flip number one. And notice what Nina really did. She separated the two jobs. She bought protection from an insurance company, which is what they're good at, and she bought growth from the market, which is what it's good at. Victor paid one company to do both and paid a premium for the bundling. But here's the second flip, and it's the reason honest people still sell whole life. Nina only wins if Nina actually invests the difference. Every month, for 20 years, and most people don't. They buy the cheap policy, feel the extra $400 in their budget, and it quietly evaporates into car payments and vacations. 10 years later, they have no cash value and no investments, which is strictly worse than Victor's outcome. Whole life is expensive and it's inefficient, but it is forced. It makes you save whether you feel like it or not. So the honest version of the advice isn't buy term, it's buy term and actually invest the difference automatically on the same day your premium comes out. If you know in your heart you won't do that second part, the math on paper stops describing your real life. And there are genuine cases where whole life is the right tool. So let's be fair. If you have a child with a disability who will need support for their entire life, a permanent policy solves a permanent problem. If your estate is large enough to face estate taxes, permanent insurance can create liquidity so your heirs don't have to fire sell a business or a farm. If you're a business owner, funding a buy-sell agreement with a partner. If you have a health condition today and want to lock in insurability forever. Or if you're a high earner who has genuinely maxed out every tax-advantaged account available and is looking for another tax-sheltered place to put money. Those are real. But notice what they have in common. They are all specific structural problems, not general advice. And almost none of them describe a 35-year-old with 2 kids and a mortgage. So now we can say the thing the title promised. The trap was never whole life itself. It's whole life being sold as the default to people whose actual problem is temporary. Your need for life insurance is supposed to shrink. The kids grow up. The mortgage gets paid. Your investments grow. By your 60s, if things went well, nobody depends on your paycheck anymore. And you don't need life insurance because you became the safety net. That's the goal. Buying a permanent product to solve a temporary problem is how you end up paying 15 times more for the same protection. So here's how to decide in about 2 minutes. Ask 3 questions. First, how long do people actually depend on my income? Usually until the kids are independent and the mortgage is gone. That number is your term length. Second, how much would they need to be okay without me? A common starting point is 10 to 12 times your annual income, adjusted for your debts and your situation. That's your coverage amount. And third, the honest one. Will I really invest the difference? If yes, buy term, automate the investment, and you'll win by a mile. If you know you won't, either fix that by making it automatic, or accept that a forced savings plan you'll actually keep may beat a perfect plan you won't. And to be clear, I'm not a licensed advisor. Your health and your state and your situation change the numbers, and there are legitimate uses for permanent policies. But the shape of it holds for most families. So the next time someone shows you an illustration with beautiful numbers stretching out 40 years, don't argue with them. Just ask one question. How much of my first year's premium goes to your commission? Watch what happens to the conversation, because that single question reveals more about which product is right for you than any brochure ever will. So tell me in the comments. Were you sold whole life? Are you team buy term and invest? Or did nobody ever explain the difference to you at all? And if this saved you from a 15 times price tag, subscribe. Because every week we run the real math on the money decisions everyone else just sells you.